Katie and I have noticed that in the marketplace there's been a lot of questions concerning how do you handle the Eurozone debt crisis prudently? Well, let's start with fixed income. When we work with our clients in our investment portfolios, we have a criterion standards for what countries are eligible to own their government bonds. Here's a list of eligible countries. Notice which ones are missing. Notably, Greece, Italy, Spain, Portugal, and Ireland. Why, you might ask? Well, it comes down to our fundamental principles for owning fixed income. What's the purpose of owning fixed income? First of all, it's to reduce volatility or reduce risk in your portfolio because there's low correlations. In other words, bonds tend to go up when the stocks or equities are falling. Secondly, we have to have something to rebalance against when equities fall. So if equities are falling, if we have high quality government bonds, we can sell off those bonds to buy more of equities. In other words, have something to rebalance against. To meet that purpose, what are some of the criteria and standards that we need? Government bonds only, no corporates. Look, in 2008, corporates fell just as much as equities did. Secondly, high quality, AA rated or higher. Third, short maturities, 5 years or less. And lastly, global diversification. Obviously, U.S. corporate bonds may be doing something different than maybe German bond. Let's talk a little bit about equities. It's really interesting to me that when you add up the market capitalization of Greece, Italy, Spain, Portugal, and Ireland, it represents roughly 3.5% of all international stocks. When we speak with our clients, the narrative goes even broader because we have them in a globally diversified portfolio where the market capitalization in the United States is roughly 60%. All the countries excluding Greece, Italy, Spain, Portugal, and Ireland represent roughly 39%, which means that those 5 countries in question, their equities, their combined equities, only represents about 1.5% of their equity portfolio. Makes you wonder why all the hype on the media if people are prudently diversified. So what does this all mean to you? Producing wealth requires a fundamental strategy. Number one, own equities. Only equities in the long run will protect your purchasing power over long periods of time. Number two, stay fully invested. We're going to have downturns and down markets, but the only way to capture the upside and the risk premium for owning equities is to stay fully invested. Number three is globally allocate or globally diversify. You want to own the entrepreneur power and thinking of literally tens of thousands of companies scattered across the globe as opposed to only owning a handful. And last but not least is buy low and sell high. And the systematic way to do that is to rebalance your portfolio on a systematic basis and on a continuous basis. Here's the fundamental strategy. We'll share with you some of the fundamental principles that we're working with our clients on. If you're not employing these, ask yourself, why not? Remember, your survival is on the line.